Good. It didn't sound particularly believable, but I'll accept it. All right, how's homework number 1 going? Well, Natalie, I know you said you had a question about, which question was it that you had?
Like 2 and 3.
Okay. Hold on, let me pull it up here. Right. So you can see that. So a little blurry, but so question 2 is write down the present value equation needed to calculate the monthly payment on the fixed payment loan, right? So the fixed payment loan is $50,000, on rate is 5%, years to maturity is 6. So you just have to write down the present value equation for that, right? Yeah. Okay. And then for 2, what's the monthly payment on the fixed payment loan? Okay. Well, you can just use this financial calculator. Right? So click on it. Right? It's a mortgage calculator. So right here, oh, this changed around a little bit. Right? Yeah, so I won't do this for you, but what you can do is you can put down your down payment, you can put down the length of time, you can put down the interest rate, and then it will actually, is this one? No, so the 50,000 is how much you borrow, right? So for this example, there is no down payment. There is no down payment. Hold on 1 second. Actually, this has changed around a little bit. So let's just pick out. So you could, well, see, shoot. They changed this around. I didn't realize it. Figure out how to do this. So I guess you could, yeah, see, they've made this fancier than it was, damn it. And now it's not nearly as useful. Shoot. Well, after class, you know what? I'll send you another one. It used to be, they changed this so that you just actually put in the amount that you bought and it actually calculated what your payment was. And now they've messed around with it. And I had not realized this. I've used this forever. Why can't they just let a good thing be? After class, I'll send you another mortgage payment calculator that you can use for a question. Okay? I'll find another one. I'm sure there's other ones online, or maybe you can find one too, but I'll find one. But remember, the thing about calculating that fixed payment loan is that you can't do it by hand. You have to use a financial calculator, right? So actually, those of you who have a financial calculator, if you're familiar with how your financial calculator works, you can use your financial calculator too, right? So all of them are pre-programmed to actually calculate fixed payment loan. You put in, you know, if you want to solve for the monthly payment, like in this problem, you just put in what the interest rate is and how much you borrow and the yield to how many years to maturity, and then whether it's a monthly or a yearly, right? And then it will calculate it. I'll update this, okay? All right, good. How about any other questions about homework number 1? And I do think my hope is that it's pretty straightforward, right? Not too complicated, and hopefully, yeah, it will be good preparation for the exam on Wednesday because, as I said, calculating yield to maturity is, I think, pretty fundamental. for being able to understand how bonds work. So, all right. Well, what are we going to do today? Today we're going to talk about 2 chapters. This morning, I want to talk about chapter 5, which is really about the behavior of interest rates, right? So today is really about the big picture of interest rates. Why do interest rates in markets move up? Why do they move down? What are the big factors that kind of drive interest rates? And so this morning we're going to talk about chapter 5. It's a little bit more involved. Chapter 6, we're going to say for this afternoon, it's a little bit shorter chapter, all right? So that's going to be kind of our big goal today is to get through these 2 chapters. So we're going to begin by just talking about a theory of interest rates. What we're going to call the loanable funds theory. Okay. And we can say, instead of theory of interest rates, it might even be better to say a model of interest rates, right? We're going to try to develop a model that helps us think about why interest rates move up and why they move down. Okay, in this model, what is an interest rate? In this model, an interest rate is just the price of borrowing money. So if we think about an interest rate as a price, what determines prices in a market economy? Come on, you young economists. What determines prices in a market economy? Supply and demand, right? And so really, this is just the supply and demand issue. What determines the supply of funds? Well, savings. Or if we think about this in terms of bonds, when you save, you're really demanding bonds, right? Saving is the act of buying a bond. So the supply of funds is really the demand for bonds. And what's the demand for funds? Well, this is really the supply of bonds, right? So when firms went to borrow to invest, what do? They supply bonds. So let's think about a simple example here. Okay, so let's just talk about a 1-year discount bond. What's the yield to maturity equation for a 1-year discount bond? How do we calculate yield to maturity again? We equate the price with present value of future payments, right? So let's say, so this is what the equation is, right? The price is equal to the present value of future payments. I'll put in here that we're talking about a $1,000 discount bond, right? So what should be the price? The price should just be the present value of future payments. This one's easy because it's just a 1 year, right? So that makes the discounting very easy. So notice here, we see the law of the bond market. What happens when interest rates go up? What happens to prices, prices go down, right? So in other words, we could rewrite this. We could also rewrite this in this way. To see this relationship between the price and the interest rates. So when interest rates go up, prices need to go down. Prices go down, interest rates go up. So what does a bond market look like? Well, the bond market, as I said, is just an application of supply and demand. Where here we have the quantity of bonds and here we have the price of bonds. What's true about the demand for bonds? Which direction does the bond demand slope? Downward, like most demand curves, right? Why? First off, who determines bond demand? Yeah, savers or lenders. So when bond prices go up, does that make a bond more attractive or less attractive? Less attractive, and so they buy fewer bonds, right? When bond prices go up, that makes the yield to maturity on these bonds go down, so you want to hold less bonds. And then when bond prices go down, that increases yield to maturity, right, and increases the demand for bonds. So that's bond demand. Remember, bond demand here is determined by savers or, in some sense, lenders. What's bond supply? It's upward sloping, and it's determined by borrowers. Whoever is a borrower in the economy is going to determine bond supply. And why does this look up? Why is this upward sloping? Well, it's upward sloping because when bond prices go up, that means the yield to maturity goes down, and so it's cheaper to borrow. So high bond prices make it cheaper for firms to borrow. So the key thing here to note is that bond prices are on this axis, right? Where are yields to maturity on this graph? Well, they're on the equation, but the way your book does this, which is clever, maybe a little confusing, but it chooses to put a second axis with yield to maturity. But here's the trick. Bond prices moving up go in this direction on this axis. The yield to maturity gets higher by moving down on this axis. Right? So think about a bond that was selling at $850. According to this equation, what's the yield to maturity on this bond? Anybody got a calculator? It would be 1,000 divided by 850 minus 1.
$17.6%.
Right. Okay. So if the equilibrium in this market was $850, that would imply a 17.6% yield to maturity. What happens if the price went up to 900? What would the yield to maturity then be? $1,000 divided by 900 minus 1, 11.1%. And what would yield to maturity be if bond price was 1,000? It would be 0%. What if bond prices were 800? What would the yield to maturity be? 1,000 divided by 800 minus 1, 20. %, sorry. So this is a strange looking graph because we're not used to seeing higher values go down, right? The right-hand side of this looks a little different, but it's really reflecting the fact that when bond prices go up, yield to maturity has to go down, right? So here we have a simple application of supply and demand. You have bond demand, bond supply, assuming that this market is perfectly competitive, which is not a great assumption, but I think for our purposes today, and thinking about why interest rates go up and go down, it's not an unreasonable assumption for what this model is trying to do. You know, this kind of tells us then what bond prices should be, and once you know what the bond price is, you know what the yield to maturity is. Okay. What would happen if bond prices were at 800 in this market? Is that an equilibrium? No. Notice that if bond prices of 800, yield to maturity is way up here at 25%. So bond supply would be down here, right? In other words, nobody wants to borrow at such a high interest rate. But of course, lots of people would like to lend at that high interest rate. So what we hear is we have a shortage. What's going to happen over time? What should happen in the bond market? The price should go up, the interest rate should go down, and we should move in this direction back toward equilibrium. How quickly will this process take place? Well, it depends how competitive the market is, right? It depends how competitive. How many buyers and sellers are there that are actually out there moving prices? And the same thing, what happens if bond prices are at 900? Well, now we have a surplus of bonds, right? And how are firms going to get rid of this surplus? They're going to have to raise yield to maturity and drop the price to get rid of these bonds. So once we have this framework, then we can use this framework to think about what kind of things drive market changes in market interest rates. And really, it's pretty simple. What's going to drive changes in market interest rates? Things that impact bond demand and things that impact bond supply. Okay? So it's things that impact bond demand and things that impact bond supply that will cause changes in interest rates. So let's talk about some of those things. Now that I made that beautiful graph, I will erase it. Right? Okay, things that impact bond demand. Once again, who is it that's primarily determining bond demand? borrowers or savers, right? Not borrowers, lenders. Well, whatever you said, I was going to write down, right? Yeah, lenders, right? Lenders or savers. And so to ask this question, well, what kind of things impact bond demand is really to ask the question, what kind of things would impact savings or people's willingness to lend in an economy? All right, so help me out. What are some things that might impact people's ability to lend? Yeah.
The liquidity of bonds.
Liquidity. This is what your reading was about, right? Right? So liquidity, meaning basically what are the transaction costs? How much is it going to cost me to buy and sell the bond? So let's talk about this reading here a little bit. So there's a reason why I gave this to you. Outside of having a relationship to our readings, I also gave this to you because this is what a lot of financial reporting looks like. Not particularly well written, a lot of lingo, right? It's almost like they're trying to make it difficult for you to understand, right? And so I think that's definitely true about this. You know, I think the things in The Economist are they might be dense, but they're pretty well written. This is not really particularly well written, right? There's not really a big effort here to make things clear to you, right? They kind of assume that there is an immense amount of background information needed. And so if you're going to read these things, you really kind of have to not just kind of read things like ETFs and principal-based financial fixed income instrument and all this kind of stuff. You really got to figure out what these things mean. Right? If you're going to understand this article, you're going to have to understand what these things mean. What is a fixed income instrument? What do we mean by fixed income?
It's an asset that comes with a fixed payment.
Right, exactly. It doesn't have to be a coupon bond, right? There's other kind of bonds, and there's also some things outside of bonds that can be called fixed income. But it's just something that has a guaranteed payment, right? So most equity or most stocks are not fixed income, right? What's happening here, if we look at this first graph, what's happening in the trading of investment grade bonds? Who's doing the trading increasingly? It's kind of taking place face-to-face, good old boy networks. Yeah, it's becoming increasingly electronic, right? It's becoming increasingly electronic. So bond markets traditionally have not been kind of big and efficient like stock markets. They've been much more kind of personal relationships. Certain dealers will kind of specialize in certain kind of bonds, and you have to work with one or two dealers if you want to buy or sell certain kind of bonds. And so, you know, whenever you think about one or two dealers, what you're talking about is like a lot of people have market, right? Basically, market power. And so one of the things this thing talks about is the bid-ask spread. What's a bid-ask spread? Exactly. Particularly from a dealer, right? So a dealer will give you one price to buy and one price to sell. And one measure of how efficient a market is what's the difference between these bid and asks. In treasury bills, the difference is minuscule because they're highly competitive, highly efficient markets. But you know, one of the things we've seen traditionally in bonds is that they have been very high. For most bonds outside of treasury bills, they've been very high. But one of the things that electronic trading has allowed investors to do is actually reduce their bid-ask spread, right? It's created by more competition. And so electronic trading, right? Just to be clear, what we're talking here is electronic trading. Electronic trading has kind of reduced these bid spreads, right? It's reduced these bid spreads and made it much more competitive. Having said that, are most bond markets liquid in the sense that stock markets are? No, and I think that's one of the points that your book or that this article tries to make is they're still not liquid. So one of the more interesting things that they have here is they talk about turnover. They never define turnover. So once again, this is something you as a reader, you got to go out there and figure out what in the world is turnover. All right? So what does turnover mean? Turnover basically means the number of outstanding bonds divided by the number that are actually traded. In a period of time. So interestingly, in the stock market, for most stocks, if you look at turnover, it's like 2, 3, meaning like half the shares of a stock will be traded in a given year. What is it for most bonds? 7, 8, right? Meaning, are most bonds traded very actively? Right, not. They're just not, right? They're just not. And it still remains to be the case. In fact, turnover in some ways is kind of, well, it has fallen, right? Most bonds are just not traded. Meaning that still, it's pretty clear that most investors follow a buy and hold strategy with bonds. That might be smart. As we're going to talk about tomorrow, most economists argue that a huge mistake most investors make is they don't follow a buy and hold strategy. That trying to trade too much is one of the things that eats up your return, right? That in general, it's good to follow a buy and hold strategy. But what's the downside? The downside is if you do have to sell, it's really hard to sell, right? It can be really hard. So even though these markets are more competitive, right, it can still be hard to sell. The third thing from this is that increasingly bonds are driven by ETFs. Okay, what's an ETF?
Exchange-traded bond.
Exchange-traded bond. Want to explain what this is? Horace will. Yeah, so when we read these kind of articles and you see something like this, you got to do a little bit of research, right? Got to do a little bit of research. That doesn't always mean that it's going to be easy to understand, but you got to try to understand it. What is an exchange-traded fund? Basically, it's a mutual fund. It's basically a mutual fund. The only difference is that these shares of the mutual fund can be traded on an exchange. okay? So a traditional mutual fund, let's say with Vanguard, you would open an account with Vanguard and you'd put money into Vanguard, and then if you didn't like it, you'd take your money out of Vanguard, right? And how long did that process take? You know, it's not instant, right? You put your money into Vanguard, and it might take them a couple of days to actually get it in there. And then if you pull it out, they'll usually say, well, you have to give us 48 hours to make the trade. So it's fine for most investors, but it's not super liquid, right? And you have to have an account with Vanguard, right? An exchange traded fund is when Vanguard has actually created a share that owns a part of a Vanguard fund. And this share can be traded instantly on markets. So it's much more liquid, and it basically allows more people, even people who don't have accounts with Vanguard, to trade on these things. Many of these exchange traded funds are very specific. And I think that's one of the things that often appeals to people here. It's like, let's say that you're really interested in speculating on the financial system, on banks. You could buy an exchange traded fund that just holds stocks of banks. And then you can trade that, right? So it's kind of a way of betting on industries without having to buy individual stocks. But one of the things that they talk about here is that more and more people are getting away from buying individual bonds and buying these ETFs that are full of bonds, right? And so this is one of the big changes that we've seen is more and more it's institutional investors that are driving markets. Not that individuals invest in the stock market, but how do individuals invest? Through institutions, through buying these exchange-traded funds that are created by mutual funds or investment banks or somebody else. Right? So more and more, and this is almost certainly a very, very good development, but more and more it's becoming less and less likely that an individual owns an individual share of stock. Right? Most investors just don't do that anymore, and that's probably smart, right? Most investors just don't say, oh, I like Apple, I'm gonna go buy some shares of Apple stock. You can do that, but I think for reasons we'll talk about tomorrow, that is not the best investing strategy, right? And so how do people buy shares of Apple stock? Well, they hold them indirectly, right? By putting money in a mutual fund, and that mutual fund will then buy shares in that. So anyway, so there's a couple of purposes of, of this article. One was to kind of talk about this stuff, but the second was really to impress upon you that, you know, financial writing is not good. I just say it. In general, I don't find it very good. So when you're given something like this, you really got to dig into it a little bit, right? You really got to dig into it. When they use terms like turnover or ETFs, you got to try to find out what they're talking about, right? Because oftentimes, you know, they're just going to assume that you know a lot more than probably you do at this stage of your career, right? And so reading this kind of stuff and trying to get caught up on the background is really important to make sure that you're prepared if you decide that you want to go into a job in finance. All right, certainly liquidity impacts bond demand, but there's a lot of other things that impact bond demand. What else? What else? What other kind of things impact people's savings?
Interest rates.
Well, right. I think we can be more specific. Your expected return. Right? This is a movement along your bond demand curve. So higher interest rates mean higher bond demand, and you move along your bond demand curve. Well, if return impacts it, what's the other, always the flip side of finance? Whenever you talk about return, you got to talk about risk, right? Risk return. Changes in perceived risk. Whenever we talk about risk in finance, we have to talk about relative risk. Relative risk. If bonds become more risky, does that mean that their demand's going to fall? Not if every other asset becomes even riskier, right? So you really have to think about relative risk, right? Do bonds become riskier relative to stocks? If they do, that's going to reduce bond demand, right? So let's think about an example where bonds become riskier. There's something that happens in the economy in which markets perceive bonds are riskier relative to stocks. What's going to happen to bond prices and yields? Bond prices go down, right? And if bond prices go down, what happens to yields? They go up. Remember, it's right? Well, it looks like it's going down, it's actually going up. How do markets make perceptions of risk? Well, that's a long conversation, probably for a better day, right? But there are clearly, you know, well, I think I talked about this in one of the lectures that I posted on YouTube yesterday, right? There's probabilistic risk and fundamental risk, right? Probabilistic means just kind of the usual predictable risk, right? The known unknowns about sometimes, you know, a certain percentage of firms are going to fail every year, right? So you know that there's some risk associated with bonds. Sometimes that risk might be randomly a little bit higher, sometimes it might be randomly a little bit lower. But then you have the fundamental risk, the risk of the things that you don't even know that you don't know, like a pandemic, right? That was a risk in the markets that was not priced into markets because markets weren't expecting it, quite honestly. And so, yeah, you really have to think about both of these kind of risks, right? Both of these kind of risks. A couple of other things. Well, obviously, something that plays an important role. If we're wealthier, we save more, right? So something that increases national wealth would lead to an increase in bond demand. Tax law is undoubtedly one of the things that impacts bond demand. So an example of this would be a tax law that over the last few years has changed periodically, which is the capital gains tax. Okay, so the capital gains tax is whenever you own an asset and that asset goes up in value, up in price, you have to pay a tax on that appreciation. Okay. Now, sometimes that capital gains tax has been increased. Sometimes it's been cut. Right. Recently, the capital gains tax has been reduced. Most capital gains taxes, I believe, are 20% now, which is lower than your average income tax. So when people talk about capital being at an advantage over work, this is one of the ways, right? We actually tax capital at a lower rate than we do work, which creates some, how should we say it, some inequalities in our economic system, right? But what's the idea behind a capital gains tax cut, right? If you cut capital gains tax, the idea is what would happen to the demand for bonds and stocks. This should encourage people to buy more bonds and stocks, right? Because you get a higher return. And this would, we draw our graph here. An increase in bond demand increase price, reduce interest rates. One final thing to talk about. And this goes to a topic that we discussed yesterday, which is the difference between nominal returns and real returns. And that's something else that an investor has to think about. In other words, what is the expected inflation rate? And how is that going to impact my real return on holding a bond? What happens if markets get scared and fear that inflation is going to be going up in the future? Yeah, that's not going to make bonds more attractive, right? It's going to definitely make bonds less attractive because it's going to eat away at your real return. We'll come back and talk about this in a minute in more detail because we really have to understand the very important role that expected inflation plays in bond markets. Okay? But for right now, I think this is pretty intuitive why higher expected inflation would reduce bond. What about bond supply? Right, we've talked about all these things that impact bond supply. I'm sorry, all these things that impact bond demand. Let's talk a little bit about bond supply. When we talk about bond supply, we're talking about the act of borrowing, things that are going to impact the amount of borrowing in the economy. All right, help me out. What's going to impact how much people or firms want to borrow? Right, and particularly whether there's profitable opportunities out there, right? I mean, profitable business opportunities. Right, having profitable business opportunities All right, what's happened to bond supply during the COVID era? I think there's a lot of firms that have been really excited to get out there and make big investment projects. No, there's too much uncertainty, right? There's too much uncertainty. So, certain. COVID has reduced bond supply because firms are uncertain, right? Future profits look more uncertain. And so they have gotten more cautious. They're cutting back on their investments. We talked about this impacting bond demand, but it also impacts bond supply. Expected inflation. Expected inflation is also going to impact bond supply and not just bond demand. What happens if expected inflation goes up? So that's going to reduce real interest rates. What impact does lower real interest rates have on borrowing? Increase, right? So what's bad for borrowers, what's bad for lenders is actually good for borrowers here. Right? Lower interest rates discourage lending, but they encourage borrowing. We've been talking about borrowers as if it's the public and sometimes firms, but actually who's the biggest borrower in the US economy? The government, right? And so government borrowing. The US government is projected to run about a $2 trillion deficit this year because of COVID. What impact is that going to have in the bond market? What impact should that have? Well, when the government borrows, what are they doing? They're issuing bonds, right? And so bond supply goes up. What happens to prices? They go down. What happens to interest rates? They go up. And we talked about this in principles. All of us talked about this in principles. This is the phenomenon that we call crowding out. Right? Crowding out. Right, this is the phenomenon that we call crowding out. What happens when governments run big deficits? They drive up interest rates. And that makes it more expensive for regular people to borrow money. Okay? So that's what we call crowding out, right? That when the government borrows up all the money, it means it's more difficult for private individuals to borrow money because interest rates are higher. So interest rates are at an all-time high in the US, right? No. We're going to come back and talk to this. Why aren't we seeing crowding out when the government's borrowing money like this? Well, there's a lot going on, right? There's more than just this going on in the economy. But we'll come back and talk about this. So this is, these are kind of all the things that you have to think about when you're projecting interest rates, right? So if you're making some sort of projection about what's happening in interest rates in the future, you have to think about at least these things. And quite honestly, there's other things probably that we haven't talked about here that still matter, right? So there is a lot going on, a lot of different things impact interest rates. I want to talk about a couple, though, just as a way of review, that are really the most important. Expected inflation is very, very important when understanding interest rates. Let's say that markets get worried that inflation is starting to rise. What should happen in the bond market? Supply goes up and demand goes down. And so what happens? Prices go down and yields go up. Right? Prices go down and yields go up. In fact, we can say a little bit more about this. If expected inflation was supposed to rise by 1%, how much do we think that interest rates will rise? So if expected inflation is supposed to rise by 1%, how much should interest rates rise? 1%. Right? And this is called the Fisher effect. So a 1% increase in expected inflation should lead to a 1% increase in nominal interest rates. In other words, what should happen to real interest rates? They should stay the same. Real interest rates should stay the same. Nominal interest rates adjust to accommodate this higher level of inflation, right? So in other words, nominal interest rates should track expected inflation very, very closely. Do we observe this? Well, yes, but there's a caveat, and there always is in economics, right? There is a caveat. Okay. The red line is the nominal interest rate, and the blue line here is expected inflation. Do they move together? Yeah, pretty closely. Pretty closely. Is it perfect? No, it's not perfect. And I think there's a couple of reasons why it's not perfect. First off, expected inflation is a very difficult thing to measure. So there's our measure of expected inflation is probably imperfect, right? And so I think that's probably the biggest reason, right? That's probably the biggest reason why. But then also, it's just important to remember that there's things going on other than expected inflation that impact interest rates, right? So we're never saying that expected inflation is the only thing that matters, but over the long haul, yes, there's a very close relationship between these things, right? So the Fisher effect is, I think, a good description of a pretty good rule of thumb for how the world works, right? That interest rates are going to adjust on a one-to-one basis with expected inflation. Other things impact inflation, or I'm sorry, other things impact interest rates, but definitely inflation is one of the big ones, right? One of the big ones. Nothing will freak out bond markets more than changes in expected inflation, right? If there is any hint that inflation is going to be different in the future than what bond markets think it is today, that will lead to massive freakouts, right? Massive, because expected inflation is really important in determining what that real return is from buying a bond, right? Absolutely fundamental. Okay, how does business cycles impact interest rates? Things like booms and recessions. How do they impact interest rates? Okay, well, let's see. We just have to open up the newspapers, right? The U.S. is in a pretty big recession right now because of COVID, right? GDP is down between 5 and 10%, right? Which puts it at one of the bigger recessions in U.S. history, right? Not as big as the Great Depression, but roughly in order of the 2008 financial crisis, right? So big recession. How do we think this has impacted bond demand and bond supply? How about let's take bond supply first. Are firms issuing as many bonds as they did? No, and this gets back to that profitable investment opportunities, right? Bond supply in general has gone down. What about bond demand? What do you think? Right, so there's more perceived risk. I don't think there's any doubt that there's higher perceived financial risk right now, right? When the economy's struggling, we don't know what companies are really in trouble. What companies could go bankrupt, right? That's not a big inducement to buying bonds. I think the other thing that's going on is that in addition to there being more risk, what was I going to say? Oh yeah, our wealth is falling. Right? If people lose their jobs, they're eating up their savings. Maybe they had money in the stock market that might have collapsed, right? So their fallen wealth has also reduced value. So what does this mean? Okay, here we are. We have a recession. What happens to bond supply? goes down. What happens to bond demand? It goes down. What happens to prices and interest rates? What can we say? Well, the way I drew it, they stayed the same. But what if I would have drawn it like this? Then what would have happened? Then prices and interest rates would have gone down, right? The best answer here is it's indeterminate. It's indeterminate what usually happens. At least in our model, it's indeterminate. Our model doesn't have a clear prediction about what should happen. But experience tells us a lot. In reality, what we observe is that interest rates are pro-cyclical. In other words, when output falls, interest rates tend to fall. When output rises, interest rates tend to rise. So how do we reconcile that with this over here? Well, is what I have here a good description of reality, where bond demand falls by much more than bond supply? No, because that would mean prices went down and yields went up. A better description would be this. Bond supply falls a lot, relative bond demand. So where do we end up? We end up at this place where prices go up and yields go down. In other words, the change in bond supply is bigger than the change in bond demand. That's how we explain what we observe in reality. And so time and time again, we observe this relationship, that interest rates are pro-cyclical. I can just show you. This is figure 7. Okay, a little hard to see, but this is really hard to see up here. But here we have interest rates, right? The blue line is interest rates. And then these shaded areas are recessions. And notice what happens during recessions. During recessions, interest rates go down, right? This is a pretty strong relationship. Markets believe this to be the case. Markets believe that when the economy gets weak, interest rates go down, and when the economy is strong, interest rates go up, right? It's a strong prediction. This is one of the things that this explains one of these phenomena in the bond market that some people have a hard time understanding, which is good news is bad news in the bond market. Right? Good news is bad news for bond markets. Why? Because if it's good economic news, what does that mean is going to happen to interest rates? They're going to go up. And if interest rates are expected to go up, What's going to have to happen to bond prices? They're going to go down. People in bond markets will take capital losses, right? So, good news for the economy is often bad news for people who hold bonds, and vice versa, right? Now, of course, there's a limit to that, right? I don't know that it's always true to say that bad news for the economy is good news for the bond market, because if it's really bad news, then companies could default and not get your money back, right? So, like most things, there's an element of truth to it, but it's not universally true. But yes, if you follow the bond market on a day-to-day basis, you will see this. So just for instance, I could pull it up, but yesterday, actually, let's go back the last couple of days. There's been a very volatile day in financial markets. So Monday, President Trump said that there was going to be no more economic relief from the federal government to help the economy. So how did markets respond to that? Stock markets tanked. But what happened to bond prices? They went up. Yay. Right? Good for bonds, bad for stocks. Then Monday night, Trump says, no. I think I still want to do a program. And so what happens yesterday? Bond prices go down, right? Stock prices go back up, right? That's a fairly regular occurrence, right? Good news is bad news for the bond markets. So bond markets, prices of bonds often move in directly the opposite way of stocks. Why are interest rates so low right now? Well, I think there's many things that are going on. Let's talk about a couple of them. One is the fact that there is a lot of global savings. And a lot of this savings finds its way into the US bond market. As we talked about yesterday, the US bond market is the biggest bond market in the world by a good amount. And so people who want to save in bonds really find themselves, in some way, shape, or form, saving in US bond markets, right? And so the US just attracts a lot of global capital. And so this tends to drive down interest rates, right? This is clearly one of the reasons why interest rates have been lower in the US over the last 10 or 15 years, right? This is not just a new thing. This has been going on for a long time. What are some of the new things? Well, the recession, right? For reasons that we just talked about, when output goes down, we tend to see interest rates go down. And so the recession has driven down interest rates. We are also in a period of low expected inflation. This isn't something that's new. This has been going on for, once again, the last 20 years or so, where the US has kept interest rates or inflation relatively low. And then there's one other thing, and this is what we have to talk about next. We've got to talk about the Fed. How does the Fed and central bank policy fit into all of this? And so that's really kind of our last topic here this morning, is to talk about how Federal Reserve policy impacts interest rates. how does monetary policy and the Fed impact interest rates? Okay, this is complicated. You won't be surprised to know this is complicated. And as we go along in this block, I'm going to complicate this story more. But for right now, I think let's talk about the simple story of how the Fed does this. Okay, the simple story. And then, as I said, we'll maybe get a little bit more detailed and try to understand some more of the intricacies as we go forward. But the simple way is the Fed conducts open market operations. This is kind of, you could say, this is the Fed's go-to move. Right? This is the way the Fed traditionally tries to manage interest rates. It's not the only way the Fed does it, right? And we'll talk about many other things that the Fed is doing, particularly right now. The Fed is doing many different things to influence interest rates. But kind of the go-to or the old school way that they do it is through open market operations. So what happens when the Fed buys a T-bill? The Fed goes out and they buy $10 million of T-bills. What are they doing? Right, right. So they are increasing the money supply and increasing bond demand. They buy those bonds. How do they pay for them? Need up money. Money out of thin air. The Fed has the ability to create reserves. So the Fed will put money in a bank's account, buy the bonds from them, and that's it. The Fed can do this. By increasing bond demand, what are they doing to interest rates? They're increasing prices and decreasing interest rates. This is what we call the liquidity effect. That when the Fed increases the money supply, it increases interest rates. I'm sorry, when the Fed increases the money supply, it decreases interest rates. Okay, that's the simple story. But even this simple story is not quite that simple. Because what happens if the central bank just kept on increasing the money supply? Right. I mean, there's more to it than this. Okay. The rest of the story is that there's also an inflation effect. It's possible that if the money supply goes up, expected inflation will begin to rise. And what does higher expected inflation do? That puts upward pressure on interest rates. So which is it? Which is it? Okay, which is it? So here's kind of three alternatives that are sketched out by your book. And granted, this is very hard to read. Maybe I should just sketch this out, but we'll try it this way. What happens when the Fed increases the money supply? One alternative is the interest rates fall, and then over time, maybe there's a little bit of bump back in inflation, but in general, interest rates stay lower than they were. Or there's the opposite scenario, where the liquidity effect kicks in immediately, but then the expected inflation effect begins to kick up and it drives up interest rates. And then the third scenario would be there's hardly any liquidity effect. All this does is increase inflation. Which of these three appears to be the most plausible? This one. In other words, in general, the liquidity effect is bigger than the expected inflation effect. But that doesn't always have to be the case, right? Particularly if a central bank loses the confidence of markets. If markets begin to worry about inflation every time the central bank changes the money supply, you could have a much bigger expected inflation effect. So let me write that down, because I think this is so important to understanding a lot of our the rest of our conversations related to the Fed and interest rates and whatever. When central banks have market confidence that they are committed to keeping inflation low, then the liquidity effect is greater than the expected inflation effect. So when central banks have market confidence that they are committed to keeping inflation low, then they can really rely on the liquidity effect. In other words, when you increase the money supply, you can cut interest rates. We will talk about confidence in monetary policy so much, because really, in many ways, this is the most important thing that a central bank, if they're going to do their job, has to maintain, which is a sense of confidence that markets believe that they're not going to let things go crazy, including inflation. When central banks have market confidence, they have more power, right? And so the Fed, in general, is able to use this liquidity effect because markets have a lot of confidence that the Fed's not going to let inflation get out of control. Why did it have that? In part because the Fed can say, look at our track record. Look at what's happened over the last 30 years, right? We have maintained stable inflation. You can trust us. Will that hold in the future? Who knows? Could we get a rogue central banker in there that would go crazy? Sure, we could, right? I mean, the past is never a perfect indicator of the future. But at least right now, markets have a lot of confidence. But what happens in a country where there is no confidence in the central bank? What happens if the central bank then tries to drive down interest rates by increasing the money supply? It's probably only going to lead to inflation. It's only going to lead to inflation, right? So you're not going to get the same effect in Zimbabwe as you get in the United States, right? In Zimbabwe, There's a long history of incompetent monetary policy. The government, we'll talk about this, the government basically runs monetary policy to pay their bills. There's very little economic stability, and as a result, markets don't trust them. They don't trust them. And so when the central bank changes monetary policy, you get a much different effect. So this is, I think this is a really important lesson for us, and something that I think is really important to keep straight. You can't say, you can't necessarily tell anything about monetary policy based on the level of interest rates alone. You can't necessarily tell anything about monetary policy based on the level of interest rates alone. If a country has low interest rates, what could be driving that? Well, it could be the liquidity effect. But it could also be that the country has kept expected inflation low by not increasing the money supply in general. That's kind of where we are here in the United States, right? That in general, the Fed has kept expected inflation low, but now they're also trying to use the liquidity effect, right? Because they have confidence. Markets haven't said, oh, well, that's going to lead to inflation. In general, markets believe that the Federal Reserve will pull back when they need to. Okay. Likewise, high interest rates could mean that inflation has been, or that the money's growth has been very high, driving up inflation, or it could mean that money growth has been very low, meaning the opposite of the liquidity effect, right? In other words, high interest rates could also be driven by cutting the money supply. You don't know. Just looking at the level of the interest rate by itself doesn't tell you that. You need to know the context. So, right, it's complicated, right? It'd be nice if there was kind of like one simple answer to this, right? It'd be nice to say, well, low interest rates mean the central bank has been keeping money growth low. No, you need to know more than that, right? You need to know more. You need to know about the historical context largely, right? And what led to the point that you're at. And so, yeah, we will obviously be talking a lot more about monetary policy as we go along, right? Because you have to understand the Fed if you're going to understand interest rates and how the financial system works, right? But this is kind of a little introduction to it. And as we go along, we will continue to kind of complicate this story, right? And it will get pretty complicated. All right, that really takes us to the end of our time, and that really takes us to the end of chapter 5. So does anybody have any questions about this? So we'll meet back here at 12:30. We'll talk about chapter 6. Chapter 6 is a much shorter chapter. I would hope that we would maybe only need about an hour or so this afternoon, okay? So anyway, enjoy your lunch. Have a good break, and we'll see you back here in a little bit.